Ladies and gentlemen, Asian guy here. We need to stop looking at the charts for a moment. We need to stop looking at the RSI, the moving averages, and the colorful lines on the screen. We need to look at something far more important. We need to look at the clock. Today is Tuesday, December 30th, 2025. Take a good look at that date. Burn it into your memory. Because we are standing exactly 48 hours away from the most significant structural change in the history of the global silver market. We are 48 hours away from the moment the ball drops. Not in Times Square, but in Beijing. We are 48 hours away from the January 1st China export ban. But if you think the market is waiting for January 1st to panic, you are dangerously mistaken. If you think the banks are going to wait for the official press release to start running for the exits, you do not understand how this game is played. The panic has already begun. It is happening right now beneath the surface in the dark pools in the vault corridors where retail investors cannot see. What we witnessed this morning in the span of less than 60 minutes was not a series of random market fluctuations. It was not normal volatility. It was not endo-fear profit, taking a king. It was a coordinated systemic seizure. It was a glitch in the matrix that proves beyond a shadow of a doubt that the Western financial system is running out of time while the Eastern physical market is running out of metal. We are watching two massive tectonic plates collide in real time. At exactly 8:15 a.m. Eastern Standard Time, while most of you were making coffee and watching the pre-market futures, the Federal Reserve quietly executed an emergency liquidity injection. They didn't hold a press conference. They didn't tweet about it. They just opened the valve and flooded the banking system with cash. And at the exact same moment, down to the minute, half a world away, the Shanghai Gold Exchange witnessed one of the largest physical withdrawal events on record. You have the United States printing money to save the paper market. You have China draining the vaults to secure the physical market. And you have these two events happening simultaneously on the very same morning, just 2 days before the supply chain locks down forever. Do you believe in coincidences? Do you believe that it is just a fluke that the U.S. banking system needed a sudden infusion of $3 billion at the exact same moment the Chinese industrial complex decided to remove 41 tons of physical silver from the exchange? In the financial world, there are no coincidences. There's only leverage and the breaking of leverage. There's only action and reaction. And today, we heard the sound of the main beam cracking. We are watching a tale of two markets reach its absolute breaking point. We are watching the divorce of the paper price from the physical reality. The papers are being served today. On one side, you have the paper system in New York, the comics, the world of derivatives, of high-frequency trading, of promises to pay. This system is so stressed, so fragile, and so over-leveraged that it required a $3 billion emergency patch job before the market even opened today just to keep the gears from grinding to a halt. Think about that. $3 billion. That is not small change. That is emergency room triage. On the other side, you have the physical system in Shanghai, the SGE, the world of factories, of solar panels, of strategic reserves. This system is entering a state of total vacuum. They are not just buying silver to trade it. They are evacuating it. They are taking delivery. They are loading it onto trucks and driving it into private stockpiles where it will never see the light of day again. They are treating silver like a strategic asset that is about to vanish from the face of the earth. This is the definition of a squeeze, but a squeeze isn't just a price going up on a chart. A squeeze is when the paper price and the physical reality collide violently. A squeeze is when the people holding the paper realize there isn't enough metal to go around, and the people holding the metal refuse to sell it back. And that collision started this morning at 8:15 a.m. If you are holding silver right now, I am begging you, do not let go. Do not let the volatility shake you out. Do not let the sudden drops scare you. Do not let the media narrative about volatility fool you, because what I am about to explain to you, the specific data points regarding the Federal Reserve's panic and China's hoarding, will show you that the suppression game is over. They aren't smashing the price because they are strong. They aren't manipulating the market because they are in control. They are smashing the price because they are terrified. They are manipulating the market because they have lost control. The system is blinking red. The alarms are sounding in the repo markets. The vaults are emptying in Asia. And in the next few minutes, I'm going to walk you through exactly what happened this morning. I'm going to connect the dots between a $3 billion injection in New York and a 41-ton withdrawal in Shanghai. I'm going to show you why these two events are not separate. They are the same event viewed from two different sides of the war. The West is fighting with liquidity. The East is fighting with gravity, and gravity always wins. We need to talk about the emergency nature of this morning. Usually, when the Federal Reserve intervenes in the market, they do it with a schedule. They announce repo operations. They have a calendar. The market expects it. Today was different. Today, the liquidity appeared unscheduled. It appeared off-cycle. This is the equivalent of a doctor rushing into a patient's room with a defibrillator when the patient was supposed to be stable. It tells us that somewhere in the plumbing of the banking system, a pipe burst. It tells us that a major bank or a major hedge fund or a major clearinghouse woke up this morning and found themselves short of cash. Why were they short of cash? Because the price of silver and the volatility associated with it is blowing up their risk models. And while that bank was gasping for air in New York, demanding $3 billion to stay afloat, what was happening in Shanghai? 41 tons. Let me repeat that number so you can feel the weight of it. 41 tons of silver. That is 186 troy ounces removed from the Shanghai Gold Exchange vaults in a single morning. This wasn't trading volume. This wasn't contracts flipping back and forth. This was loadout. This was metal leaving the system. This was a Chinese entity, likely a state-backed battery manufacturer or a strategic reserve fund, looking at the calendar, seeing January 1st approaching, and deciding to sweep the floor. They didn't leave a single crumb. They took 41 tons of physical inventory out of the public market and moved it into the dark. Why today? Why December 30th? Because they know what happens in 48 hours. They know that the export ban is real. They know that the window to secure metal is closing. They are essentially looting the store before the hurricane hits. And here is the most damning part. Here is the smoking gun. These two events happened at the same time. The West needed paper money to cover its bad bets. The East took physical metal to secure its future. It is the perfect metaphor for the collapse of the fiat currency system. One side prints digits, the other side takes atoms, and the exchange rate between digits and atoms is about to explode. You have to understand the level of fear required to withdraw 41 tons of silver in one day. You don't do that if you think prices are going lower. You don't do that if you think the market is well supplied. You do that when you think there will be zero metal available tomorrow. You do that when you are in a panic to hoard. And you have to understand the level of fear required for the Fed to inject $3 billion on a Tuesday morning. You don't do that if the banks are healthy. You don't do that if the system is robust. You do that when a counterparty is about to default. You do that when the repo rate spikes and threatens to freeze the entire credit market. So we are standing at the intersection of a banking crisis and a supply crisis, and they are feeding off each other. The banking crisis is caused by the volatility in the metals, and the supply crisis is caused by the distrust in the banks. It is a death spiral for the paper shorts, and the clock is ticking. Tick-tock 48 hours. Every hour that passes brings us closer to the moment China locks the gates. Every hour that passes makes that physical silver in the vault more valuable. Every hour that passes makes those paper contracts in New York more toxic. This is why I'm calling this an emergency alert. This is not business as usual. The data we are seeing today is the data of a system in the final stages of a fracture. The divergence between the paper price, which they are desperately trying to hold down, and the physical flow which is exploding out of the vaults cannot last another week. It might not even last another 48 hours. So, if you are wondering why the price is volatile today, stop wondering. It is the sound of a war being fought. It is the sound of the Fed throwing $3 billion at a problem that money cannot fix. You cannot print silver. You can print dollars. You can print euros. You can print yen, but you cannot print the 41 tons of silver that just left Shanghai. That metal is gone. It is off the board. It has been captured by the East, and the West is left holding a bag of 3 billion freshly printed paper dollars that are chasing a shrinking pool of real assets. We are about to dive deep into the mechanics of this. I want you to understand exactly how this liquidity injection works and why it is a sign of weakness, not strength. I want you to understand exactly who took that silver in China and what they plan to do with it. But most importantly, I want you to understand that you are witnessing history. December 30th, 2025. The day the illusion broke, the day the paper market needed a defibrillator and the physical market walked out the door. Let's start by looking at the specific breakdown of that $3 billion. Because when you see where the money went, you will realize just how close to the edge we really are. Let's look at the repo market panic. And this brings us to the most critical question of the morning. The question that every mainstream financial reporter is conveniently forgetting to ask. Why did the Federal Reserve, Central Bank of the United States, have to emergency print $3 billion at 8:15 a.m. on a Tuesday? You have to understand the mechanics of the banking system to understand why this is a flashing red siren. In a normal, healthy market, banks have plenty of cash. They lend to each other overnight without thinking twice. They trust each other's collateral. The gears turn smoothly, and the repo market, the repurchase agreement market, where banks trade cash for collateral, is quiet. But this morning, the repo market screamed. At exactly 8:15 a.m., the demand for overnight liquidity spiked. A major entity, we don't know who yet, but we know they are big, went to the window and effectively said, I need $3 billion right now, or I cannot open for business. This is the financial equivalent of a cardiac arrest. When a bank goes to the Fed for emergency repo, it means the private market has shut them out. It means that JP Morgan or Goldman Sachs or Bank of America looked at this entity's collateral and said, no, we don't trust you, we won't lend to you. So they had to go to the lender of last resort. Now let's look at the breakdown of that $3 billion because the devil is in the details. According to the transaction data that flashed across the terminal, the injection wasn't just a lump sum, it was specific. $2 billion was exchanged for U.S. Treasuries. $1 billion was exchanged for mortgage-backed securities. Why does this matter? Because it tells us that someone was desperately trying to turn their high-quality assets into cash immediately. They were liquidating. They were raising capital. And why do you raise capital at 8:15 in the morning in a panic? Because you have a margin call. And this is where the silver market enters the room. You have to look at the timing. This liquidity crisis happened exactly as silver volatility was exploding. We know that the commercial banks, the big four that dominate the comics, are sitting on massive concentrated short positions in silver. We know that as the price rises and as the volatility increases, the exchange requires them to post more collateral. This is called variation margin. When the price moves against them violently or when they fear a gap up, they have to wire cash to the clearinghouse instantly. If they don't have the cash, they default. So here's the scenario that fits the data perfectly. A major player in the metals derivatives market woke up this morning, looked at the pre-market action, looked at the drain in Shanghai, and realized they were exposed. The clearinghouse called them and said, we need $3 billion to cover your risk. The player didn't have the liquidity. They tried to borrow it from other banks, but the other banks smelled blood. They saw the exposure. They saw the risk, and they refused to lend. So the player had to run to the Fed. The Fed, seeing a potential systemic failure, seeing a potential default that could freeze the comics, stepped in and printed the money. This $3 billion wasn't stimulus. It wasn't money for the economy. It was a bailout. It was a specific targeted patch to prevent a derivatives explosion from blowing up the banking plumbing. It proves that the leverage in the silver market has become a systemic threat. They are so short and they are so leveraged that a single morning of bad volatility forces the central bank to intervene. Think about what that means for you as an investor. It means the price you see on the screen is being managed by a system that is on life support. If the Fed hadn't stepped in at 8:15, what would have happened? the entity would have defaulted, their positions would have been liquidated, and the price of silver would have gapped to $100 in 10 minutes. The only thing holding the price down, the only thing keeping the illusion alive, is the Fed's printing press. But here is the catch. Here is why this bailout is actually the most bullish signal you could possibly ask for. The Fed can print dollars. They can solve a liquidity crisis, but they cannot solve a solvency crisis. And they certainly cannot solve a physical crisis. While the Fed was busy swapping $3 billion of paper for other pieces of paper, they did absolutely nothing to address the root cause of the problem. The root cause is that the physical metal is disappearing. The Fed didn't print any silver bars. They didn't fill any vaults. They just handed a credit card to a gambler who was about to lose his shirt. And this brings us back to the mortgage-backed securities. That $1 billion in NBS collateral is fascinating. Why? Because NBS are level 2 or level 3 assets. They are harder to sell. They are less liquid. The fact that the Fed accepted $1 billion of this slower collateral tells you that the distress was acute. The entity was scraping the bottom of the barrel. They were pledging whatever they had left to get the cash. It smells of desperation. It smells of a fund or a bank desk that is dangerously close to the edge. And do you know who smells that desperation better than anyone? The Chinese. Do you think the traders in Shanghai didn't see that repo spike? Do you think the strategic planners in Beijing didn't notice the stress in the US banking system? Of course they did. And their reaction was immediate. Their reaction was brutal. They didn't offer to help. They didn't offer swap lines. They went for the jugular. At the exact moment the US system showed weakness, China accelerated its endgame. They saw the West scrambling for paper cash, so they scrambled for physical metal. They realized that if the US banks are this stressed now before the export ban even hits, then the system is going to collapse when the supply actually stops. So they decided to front or run the collapse. This $3 billion injection is the tell. In poker, when a player blinks or touches their face, it reveals their hand. The Fed just blinked. They showed that they will do anything, even emergency off-cycle money printing, to keep the game going for just one more day. But one more day is all they have. Because while the Fed was fixing the plumbing in New York, a vacuum cleaner was turned on in Shanghai. And that vacuum cleaner didn't take paper. It didn't take treasuries. It didn't take mortgage-backed securities. It took the real thing. It took the one asset that has no counterparty risk. It took the 41 tons of silver that will never ever come back to the West. So when you look at that $3 billion number, do not see it as stability. See it as the cost of the lie. It cost them $3 billion just to survive this morning. How much will it cost them tomorrow? How much will it cost them on January 1st? The price of the lie is going up exponentially, and the ability of the physical market to supply the metal is going down vertically. We are now going to shift our focus to the other side of this trade. We have looked at the paper panic. Now we must look at the physical aggression. We need to dissect exactly what happened in the Shanghai vaults. Because if you think $3 billion is a lot of money, wait until you see what 41 tons of silver looks like when it vanishes in an instant. Wait until you understand the scale of the vacuum operation that China just executed. This wasn't trading. This was preparation for war. Let's look at the vault data. And while the Federal Reserve was frantically printing $3 billion of paper to patch a leak in the Western banking system, the real story, the story that will define the next decade of wealth, was unfolding in the loading docks of the Shanghai Gold Exchange. We have to look at the other side of the ledger. The Fed deals in credit. China deals in metal. And at exactly 9 a.m. local time, just 45 minutes after the U.S. liquidity panic, the Chinese industrial complex executed what can only be described as a vacuum operation. We have the data from the SGE warehouse reports. It is black and white. In a single morning, 41 tons of silver were physically withdrawn from the exchange vaults. Let me translate that for you because tons is a weight that is hard to visualize. 41 tons is 1,318,186 troy ounces. That is roughly 40 massive pallets of 1,000 bars. It is enough silver to manufacture millions of solar panels. It is enough silver to build the guidance systems for thousands of missiles, and it disappeared in the blink of an eye. This wasn't a bank moving metal from one shelf to another. This wasn't a paper shuffle. This was load out. This was an armada of armored trucks backing up to the exchange, loading the bullion and driving it away into private state-controlled storage facilities where the Western market cannot touch it. It is gone. It has been removed from the global circulating supply forever. Now you have to ask yourself the question, why? Why withdraw 41 tons on a random Tuesday in December? Why the rush? Why the aggression? Because they are looking at the same calendar you are. They see January 1st, 2026. They know that in exactly 48 hours the export ban goes into effect. The new laws aren't just about stopping silver from leaving China. They are about tightening the control of silver inside China. The licensing requirements are going to make it harder to move metal, harder to trade it, and harder to secure it. So the smart money in the East, the battery giants, the solar conglomerates, the strategic reserve managers, is fronter-running the government. They are securing their inventory before the lockdown. They are vacuuming the floor clean because they are terrified that on Thursday morning the doors will be locked. This 41-ton withdrawal has devastated the inventory levels at the Shanghai Gold Exchange. We are looking at the new warehouse totals, and the number is terrifying. Total registered silver inventory in Shanghai has dropped to 755 tons. That sounds like a lot until you realize that China consumes thousands of tons a year. 755 tons is a historic low. It is the red zone. It represents barely a few weeks of industrial demand. The cupboard is effectively bare. If another entity comes in tomorrow and demands another 40 tons, then another entity demands 50 tons on Thursday, the exchange breaks. They are running on fumes. And when an exchange runs on fumes, the price does one thing. It explodes. This is why the premium in Shanghai is expanding out of control. While the COMEX in New York is manipulating the paper price down to $75.32 using leverage and Fed bailouts, the physical price in Shanghai has completely detached. We are seeing a spread of over $5 an ounce. In Shanghai, silver is trading north of $80. In New York, it is $75. Think about the absurdity of that, a $5 arbitrage. In a free market, traders would buy in New York and sell in Shanghai until the price is matched. They would move the metal, but they can't. The vacuum operation proves that the metal is trapped. The arbitrage is broken because the flow is one way. The West is selling paper promises, and the East is taking physical delivery. This 41-ton withdrawal is the ultimate vote of no confidence in the paper price. The Chinese buyers are looking at $75 and laughing. They know it is a lie. They are happy to pay $80 or $85 just to get the metal into their possession. They are paying a panic premium. They're saying, I don't care what the chart says. I care about having the bars in my warehouse before January 1st, and the timing. I keep coming back to the timing is the smoking gun of coordination. Do you think it is an accident that this massive physical raid happened on the same morning the Fed showed weakness? No. China smells blood. They saw the U.S. banking system stumble at 8:15 a.m. with a $3 billion injection. They realized the Western shorts are vulnerable, so they ramped up the pressure by draining 41 tons of physical metal. They are twisting the knife. They are making the shortage worse exactly when the banks are least able to handle it. They are forcing a physical squeeze to coincide with a liquidity crisis. It is a pincer movement. The Fed is fighting the fire on the paper side. China is pouring gasoline on the fire on the physical side. And sitting in the middle, about to be crushed, is the commercial short seller who doesn't have the metal and doesn't have the cash. This is why I say the panic has already begun. You don't withdraw 41 tons of silver for inventory management. You withdraw 41 tons because you are scared. You are scared of the shortage, you are scared of the currency, and you are scared of the government regulations coming in 48 hours. This is hoarding, plain and simple. And when the second largest economy on Earth starts panic, hoarding the most conductive metal on the periodic table, you do not want to be short. You do not want to be unallocated. This inventory drop to 755 tons is the signal that the buffer is gone. There is no safety net left in Shanghai. The next big order could clear out the remaining stock. And if Shanghai defaults, if they declare force majeure and say they cannot deliver, then the $5 premium becomes $50. The paper market in New York will become irrelevant overnight. So we have the Fed printing $3 billion to save the banks. We have China draining 41 tons to save their industry. But there is a third piece to this puzzle, a piece that shows just how fraudulent the Western market has become. We have to compare the volume. We have to look at how much paper silver was traded in New York today versus how much real silver was delivered. The ratio is sickening. It exposes the fraud at a level we have never seen before. While China was moving real bars, New York was trading fantasy contracts. Let's look at the 4,000 to 1 leverage ratio that proves the COMX is nothing but a casino waiting to burn down. Let's look at the paper fraud. To truly understand why the price of silver is $75.32 instead of $100, we have to look at the casino floor in New York. We have to look at the COMX. While the Chinese were moving heavy bars of real metal, the traders in New York were playing a video game. They were trading paper silver, and the volume numbers that came out of the exchange today are not just anomalous. They are mathematical obscenities. I'm looking at the final volume tally for Tuesday, December 30th. In a single trading session, the COMX traded 276,000 contracts. Now, let's do the math. Each contract represents 5,000 ounces of silver, $276,000. 5,000 equals 1,380 million ounces. Let that sink in. 1,380 million ounces. That is nearly 2 years of global mining production traded in 6 hours on a Tuesday in December. Do you really believe that 2 years' worth of silver changed hands today? Do you believe that the mines in Mexico and Peru dug up 1.38 billion ounces overnight and shipped it to New York? Of course not. It is a fantasy. It is a digital illusion. It is high-frequency algorithms trading the same paper contracts back and forth thousands of times a second, creating a storm of fake supply to drown out the real demand. But here's the statistic that exposes the scam. Out of that ocean of 1,380 million paper ounces, how many ounces were actually stood for? How many contracts actually resulted in a delivery notice? Meaning the buyer said, I want the metal. 69, not 69,000, just 69 contracts. 69, 5,000 ounces equals 345,000 ounces. So, let's look at the ratio. On one side, you have 1,380 million ounces of paper volume. On the other side, you have 345,000 ounces of physical reality. The leverage ratio is $4,000 to 1. For every 4,000 ounces of paper silver sold on the screen today, only 1 single ounce of physical silver actually moved. This is not a market. This is a fraud. This is a fractional reserve Ponzi scheme that makes the crypto markets look stable. They are diluting the price by flooding the world with 4,000 claims for every 1 bar that exists. And that is why the price has crashed. If you print 4,000 fake tickets for every 1 seat in the stadium, the price of the ticket collapses. That is basic economics. But the stadium, the physical vault, is still empty. And this fraud is exactly why the physical market has finally decided to divorce the paper market. We talked about the 41-ton withdrawal in Shanghai. That is the physical market walking away, and now the price is walking away too. We are witnessing a historic bifurcation. The two prices are splitting apart. I am looking at the closing price in Shanghai right now. The Shanghai Gold Exchange closed at an equivalent of 80.72. I'm looking at the COMEX spot price, 75.32. That is a 5.40 spread. That is a premium of over 7%. In the world of arbitrage, a 7% spread is free money. It is a flashing neon sign that says the market is broken. Why aren't the banks buying at 75 and selling at 80? Because they can't get the metal out of the COMEX, and they certainly can't get it into China before the January 1st deadline. The bridge has collapsed. The paper price of $75 is a zombie price. It exists only on the screens of the algorithms. It is the price of a contract that is leveraged $4,000 to 1. The physical price of $80.72 is the real price. It is the price of an asset that is being hoarded by a superpower. This is the ultimate rejection. The physical market is looking at the comics and saying, "Your price is irrelevant. We will pay $5 more just to avoid dealing with your paper games." The industrial buyers know that a paper contract isn't conductive. You can't put a futures contract inside a solar panel. You need the atom. And they are willing to pay a massive premium to get the atom. So when you see that $75 price on your phone, do not feel fear. Feel contempt. Feel contempt for a system that has to trade 1 billion ounces of fake supply just to keep the price down for one day. Think about the energy required to maintain that lie. They had to print $3 billion at the Fed. They had to trade 1.3 billion ounces on the comics. They had to exert maximum effort just to hold the beach ball underwater. And meanwhile, what did China do? They quietly backed up the truck. They quietly took 41 tons of real wealth off the table. They exchanged their paper trade surplus for hard assets at a discount gifted to them by the Western manipulators. This 4,000 to 1 leverage is unsustainable. It works until it doesn't. It works until the physical inventory drops so low, like the 755 tons in Shanghai, that the paper claims have nothing left to leverage against. We are approaching the mathematical limit of the fraud. You cannot leverage zero. And when the vault hits zero, the 4,000 paper claims all try to rush through the door at the same time. That is the moment the comics declares force majeure. That is the moment the price doesn't just go to $80, it goes to no offer. We have seen the Fed panic. We have seen the China hoard. We have seen the paper fraud. But there is one final piece of evidence that ties it all together. The timing. Everything we have discussed, the Fed injection, the China withdrawal, the massive paper volume, it all happened in a specific sequence. It wasn't random chaos. It was a choreographed dance of desperation. In the next part, I'm going to lay out the timeline minute by minute. I'm going to show you the smoking gun of coordination. Because when you see how the SGE margin hike at 3:30 p.m. aligns with the morning's liquidity crisis, you will realize that this is a global war for resources, and we are in the final battle. Let's look at the coordination, and this brings us to the smoking gun. We have seen the individual pieces of the puzzle. We have seen the Fed printing press in overdrive. We have seen the Chinese vacuum cleaner sucking up 41 tons. We have seen the obscene paper leverage on the comics. But to see the full picture, to understand why this is a war and not just a market correction, you have to look at the timeline. You have to lay these events out on a clock. When you see the sequence, you'll realize that this wasn't a series of accidents. It was a choreographed battle between two financial superpowers fighting for the last remaining scraps of silver. This is what a systemic seizure looks like in real time. Let's reconstruct the crime scene minute by minute. 8:15 a.m. Eastern Standard Time. New York is waking up. The coffee is brewing. The pre-market futures are volatile. And suddenly, the Federal Reserve hits the panic button. They inject $3 billion of emergency liquidity into the repo market. Why 8:15? Why then? Because that is exactly when the European markets are closing and the US books are opening. It is the moment of settlement. It is the moment where the banks have to show their cards. And one bank didn't have the cards. They were short silver. The price was too resilient, and they were facing a margin call they couldn't pay. The Fed stepped in to prevent a default that would have frozen the comics before the opening bell. 9 a.m. 45 minutes later, the news hits the wire. Or rather, the data hits the internal terminals that the Shanghai Gold Exchange has just processed a physical withdrawal of 41 tons. Think about that timing. The ink was barely dry on the Fed's $3 billion money printing operation when China pulled the plug on the physical supply. It is almost as if they were waiting for it. It is almost as if Beijing said, "Oh, you are printing paper to bail out your shorts. Fine, we will take the metal that you are trying to suppress." They used the Fed's liquidity injection as the signal to execute their vacuum operation. They know that the Fed is weak. They know the Western banks are cornered, so they escalated the physical pressure within the same hour, 3:30 p.m. Fast forward to the end of the trading day. The war has been raging for 6 hours. 1.3 billion paper ounces have been thrown at the market to keep the price at $75. And then the final blow lands. The Shanghai Gold Exchange issues an emergency notice. They are hiking the margin requirements on silver contracts effective immediately. Now, the mainstream media will tell you this is to curb speculation. They will say China is trying to cool down the market. Do not believe them. You hike margins for one reason only, to kill the leverage. China knows that the Western banks use arbitrage to manipulate the Shanghai price. By hiking the margin, they are making it more expensive for the Western paper shorts to play games in the Chinese market. They are effectively locking the door. They are saying, if you want to trade here, you need real capital, no more leverage, no more games. This forces the paper players out, leaving only the physical buyers who have the cash to pay in full. Do you see the sequence? Step 1, the West runs out of money. Fed bailout. Step 2, the East takes the metal 41-ton withdrawal. Step 3, the East locks the door on a margin hike. This is a siege. It is a coordinated strangulation of the paper-silver market. China is systematically removing the two things the COMEX needs to survive: physical inventory and arbitrage ability. They took the inventory at 9 a.m., they killed the arbitrage at 3:30 p.m., and the Fed was left holding the bag at 8:15 a.m., printing $3 billion just to keep the lights on for one more day. This level of coordination doesn't happen by accident. You don't get a liquidity crisis, a massive vault drain, and a margin rule change on the same Tuesday unless the system is breaking. These are the actions of desperate entities. The Fed is desperate to stop a collapse. China is desperate to secure resources, and the exchanges are desperate to prevent a default. And looming over all of this chaos is the date, January 1st, Thursday. Everything we are watching today, the panic, the printing, the hoarding, is happening because everyone knows that in 48 hours, the game changes forever. The export ban is the deadline. It is the cliff edge. The Fed is trying to patch the parachute. China is grabbing the last life vest. And you sitting there with your silver, watching the giants fight over the very asset you owned. This confirms the thesis we have held for years. The price of silver has been suppressed by paper derivatives. But paper derivatives require a functioning banking system and ample physical supply to work. Today, we saw the banking system crack. Today, we saw the physical supply vanish. The mechanism of suppression is failing right before our eyes. And if they needed $3 billion to survive a Tuesday in December, what are they going to need on Thursday in January? What are they going to need when the Shanghai market opens with 0 exports allowed? They won't need $3 billion. They will need $30 billion, and eventually, even the printer won't be enough because you can't print conductivity. We are approaching the moment of implosion. The tension in the rubber band is too high. The divergence between the $75 paper price and the $80 physical reality is tearing the market apart. Something has to give, and based on the actions of the Chinese today, they are betting that the thing that gives will be the COMEX. In the final part of this emergency alert, I'm going to give you the warning that you need to hear right now. We have 48 hours left. The window is closing, the paper game is ending, and the physical era is beginning. I'm going to tell you exactly what to expect in the next 2 days as we count down to the export ban. The system is breaking, and you need to be ready. Let's look at the final countdown. On Thursday morning, January 1st, 2026, the rules of the game changed forever. The China export ban goes live. The vacuum operation we witnessed today was just the rehearsal. It was the final sweeping of the floor before the doors are locked and bolted. The system is blinking red. You don't need to be a technical analyst to see it. You just need to be awake. When the central bank has to print emergency billions on a Tuesday just to prevent a repo freeze, the system is breaking. When the premium for physical metal in Shanghai hits $5 over the paper price in New York, the system is breaking. When the leverage ratio hits 4,000 to 1, the system is breaking. We are entering the phase of implosion. You have to understand what happens when a market bifurcates like this. It doesn't heal slowly, it snaps. The divergence between the paper price of $75 and the physical reality of $80 cannot exist for another week. The pressure is too great. The arbitrage is too profitable. The only reason it hasn't snapped yet is because the Western banks are using every ounce of their remaining liquidity to hold the beach ball underwater for 2 more days. They are trying to survive until the end of the year. They are trying to get their books to close on December 31st without a default. But once the calendar flips to January 1st, their mandate ends, the books are closed, and the new reality begins. And that new reality is a world where the largest supplier of silver on the planet has turned off the tap. So what should you expect in the next 48 hours? Expect violence. Do not think that the volatility is over. The banks are cornered animals right now. They know they are short. They know the metal is gone. They might try one last desperate smash to trigger stop losses. They might try to use paper leverage to drive the price down to $72 to scare you out of your position. They want your physical metal because they don't have any. They want you to panic sell so they can cover their 4,000 to 1 leverage. But you must not blink. You must look at the data, not the price. The data says that 41 tons left the vault today. The data says the Fed is terrified. The data says the inventory in Shanghai is at a historic low of 755 tons. That is the truth. The price on the screen is the lie. We are witnessing the death of the paper game. For 40 years, they have controlled the price of silver by trading paper contracts that they never intended to deliver. They suppressed the price to protect the dollar. But that game requires physical metal to back it up. You need a little bit of truth to sell a big lie. Today, the truth ran out. China took the last of the truth. And now, all that is left is the lie. And when the market realizes, truly realizes, that the paper contract is worthless because the vault is empty, the rush for the exits will be biblical. It won't be a slow rise to $100. It will be a no-offer market. You will call your dealer to buy silver, and they will say, "Sorry, we have none." You'll see. You will try to buy SLV, and it will trade at a massive discount to the physical price, because nobody trusts the vault. The price will go vertical, because there is no seller left at $75. There's no seller at $80. The only sellers are in Shanghai, and they are not selling. They are hoarding. So this is your call to action. If you have unallocated silver in a bank account, get it out. If you don't hold it, you don't own it. Today's repo panic proves that counterparty risk is real. If a bank can fail at 8:15 a.m., your unallocated account can freeze at 8:16 a.m. If you are thinking about buying, the window is closing. The premiums are already rising. The inventory is thinning. And if you are holding, stand fast. You are the smart money. Though you bought the insurance before the house caught fire, you are holding the asset that the Federal Reserve cannot print and that China cannot live without. The next 48 hours will determine the winners and losers of the next decade. The losers will be the ones holding paper promises from bankrupt institutions. The winners will be the ones holding 41 tons of physical reality. The transfer of wealth is happening right now in real time. The Fed printed the money. China took the metal. Which side of the trade are you on? The countdown is almost over. The export ban looms. The paper market is burning. And the physical squeeze is here. This is John A.G. from Currency Archive. The alert is over. The preparation is done. Now we watch the fireworks. See you on the other side. Like, subscribe, and share.